Bond markets are flashing fiscal stress just as equity earnings remain strong, and that collision is starting to show up in prices. Welcome to vTalkInsight, Equity Pulse Daily for August 21st, 2026. Today we unpack how U.S. Treasury buybacks, volatile long-end yields, and a softer dollar are feeding through to equity multiples, sector leadership, and the global risk backdrop. The defining macro story now is a bond market wrestling with fiscal dominance and volatile long-end yields. After the strongest single-day rally in long-duration treasuries since early last year, 30-year yields have already bounced back toward roughly 5.2%, underscoring how fragile the rally was. The trigger was the U.S. Treasury's surprise decision to sharply increase buybacks of 10 to 30-year debt, a move that temporarily drove yields lower, but also highlighted how nervous policymakers are about the long end. Behind the volatility sits a structural fiscal story. The U.S. deficit is running near 6% of gross domestic product. Public debt has pushed above $40 trillion, and interest costs are now one of the largest budget line items. Several signals point to term premia staying elevated because investors demand more compensation for financing these persistent deficits, even as the Treasury leans on buybacks to smooth markets. Rising yields are a global trend tied to issuance and fiscal laxity, with Switzerland one of the few exceptions thanks to tighter debt management. On the monetary side, the Fed is trying to stay data-dependent. Minutes show some officials still open to further hikes if inflation does not cooperate, but markets increasingly expect the next move to be a cut as inflation gradually moderates. Core PCE inflation has recently ticked higher, and there is a high bar for big policy shifts into the election window, so the messaging effectively supports a higher for longer rate backdrop. In that environment, curves may steepen more through lower short-end rates over time rather than a collapse in long yields, leaving long-duration equity valuations under pressure even while strong growth and profits keep investors engaged in stocks. FX and commodities are already adjusting. The dollar has weakened notably, especially against safe haven currencies like the Swiss franc, as concerns mount over coordination between the Treasury and the Fed and the sheer scale of U.S. debt issuance. Gold is benefiting from efforts to cap long-end yields, reinforcing its appeal as a hedge against fiscal dominance and potential currency debasement. At the same time, the volatility index is pushed back toward the mid-teens and the S&P 500 has slipped almost 1% in the latest session, showing equities are finally starting to react to the bond and dollar message. Against that macro backdrop, corporate earnings remain a key stabilizer, especially in the United States. U.S. earnings momentum is described as exceptionally strong, with high margins supporting a constructive near-term equity outlook. The main risks flagged are more medium-term, including potential margin pressure from the cost of adopting artificial intelligence at scale and intensifying competition from China across multiple sectors. Europe is delivering a surprisingly positive earnings story even as the equity tape looks tired. Roughly 60% of European companies have beaten second quarter expectations, with aggregate earnings growth around 18% versus forecasts closer to 15%. Strength is broad-based, led by energy, industrials benefiting from data center demand, pharmaceuticals, and banks that are still leveraging higher rates, and full-year as well as multi-year profit forecasts are being revised higher. Yet, despite that delivery, the Stoxx 600 is in its worst performance streak since 2023, and the FTSE 100 is under pressure from weakness in mining and oil stocks. Commentary notes that U.S. companies are still expected to grow earnings faster than European peers over coming years, and that European equities trade at a significant valuation discount to the U.S. The combination of strong earnings, weaker price action, and cheaper multiples leaves Europe looking fundamentally solid but sentiment challenged, which is important for global allocators comparing regions. In Asia, the Treasury buyback shock has actually lifted risk sentiment in the near term, with Asian equities and Japanese bonds both rallying as long-dated yields briefly fell. Strong demand at recent Japanese government bond auctions suggests investors are comfortable with current yield levels, which is helping local equities. More broadly, rising global yields and fiscal concerns are pushing investors toward more selective exposure in emerging markets, favoring countries with stronger fundamentals and higher carry rather than broad-based regional bets. Zooming into sectors, the U.S. consumer story is increasingly two-speed. Target has raised full-year guidance after beating earnings estimates, signaling early success in its turnaround and some resilience in big-box retail demand. At the same time, Lowe's has cut guidance, pointing to ongoing weakness in home improvement spending as higher borrowing costs and housing concerns make households wary of large projects. Walmart's latest quarter shows the same tension, with a small earnings per share beat offset by softer U.S. same-store sales and its slowest domestic growth in 6 years. Margin dynamics in retail bear watching closely. Walmart faced a roughly 1.25 percentage point headwind from pharmacy regulation and drug price changes tied to the Inflation Reduction Act, while clothing sales were essentially flat. Competitive price moves by Walmart, Target, and Kroger suggest a potential grocery price war, which could squeeze sector margins even if volumes hold up. Retailers also report consumers are avoiding big discretionary purchases, pointing to pressure on higher margin categories just as costs remain elevated. Energy is another critical crossroad for equities. Brent crude has moved above $93 per barrel amid threats of tougher U.S. economic measures against Iran, while inventories are described as approaching critically low levels. That mix raises the risk of persistently high oil prices or outright demand destruction, with obvious implications for inflation expectations, rate policy, and cyclicals such as transport and chemicals. At the same time, geopolitical and energy security worries are accelerating adoption of bioenergy solutions, with governments in regions like India, Brazil, and Southeast Asia prioritizing energy independence over pure climate goals. Company-level signals show how firms are navigating this environment. Novoni's shares have jumped after the group launched its first share buyback, beat second quarter revenue estimates, and raised full-year guidance, even while flagging temporary headwinds from inventory normalization and U.S. tariff adjustments. Its bioenergy and advanced food businesses are seeing strong global demand, and management believes regulatory expertise can offset delays in bringing novel proteins to market. In travel, Istanbul Airport has overtaken Heathrow as Europe's busiest hub, with international transfer passengers now about 45% of its traffic and passenger numbers from China up more than 50%, highlighting a structural shift in east-west connectivity that supports aviation and related services. China remains a major swing factor for global risk sentiment. The life sentence handed to Evergrande's founder, along with asset confiscations, marks a sharp escalation in the crackdown on property sector misconduct. This underscores the systemic vulnerabilities tied to excessive real estate leverage and raises fresh uncertainty around recoveries for offshore creditors as liquidators prepare to pursue assets more aggressively. It keeps a persistent cloud over Chinese property equities and related credit exposures. Consumer trends in China tell a similarly cautious story. Luxury brands have seen a sharp downturn, with some major labels dropping more than 10% in July as new offshore wealth taxes dampen high-end spending. That is a direct headwind for global luxury and premium goods stocks that rely heavily on Chinese demand, and it complicates the earnings outlook just as other regions show healthier consumption. On the technology front, artificial intelligence remains a powerful but contested driver of equity narratives. Chinese AI models have rapidly closed the performance gap with leading U.S. offerings, shrinking a prior year-long lag to just a few months, and are now winning share globally. Major U.S. technology names such as Airbnb and DoorDash are adopting these Chinese models because they are lower cost, open weight, and easier to deploy while still respecting data security constraints. Meanwhile, OpenAI's enterprise revenue has grown about 50% quarter to date, with coding revenue up 3.5 times to around $20 million, though competition from Anthropic remains intense. Alibaba offers a concrete example from Chinese big tech. The company has reported roughly 9% revenue growth, helped by demand for its AI offerings, although AI still represents only about 5% of total sales, so its profit impact is limited compared with some U.S. peers. Looking ahead, geopolitics could intersect with this tech rivalry. The U.S. is weighing tougher economic measures against Iran that could extend to its trading partners, including China, which would raise the stakes for supply chains in critical minerals, technology hardware, and energy. Any move to sanction Chinese entities over Iran could push China to source more oil on the open market, potentially driving prices higher at a time when strategic petroleum reserves are already low, and that would feed back directly into the inflation and rate discussion for equities. Putting it all together, equities are trading in the cross-currents of a fiscally driven bond market, still resilient earnings, and rising geopolitical risk. Long-end yields remain elevated despite aggressive Treasury buyback headlines. The dollar is weakening as fiscal concerns mount, and gold is firming as a hedge, all while core profits in the U.S. and Europe continue to surprise on the upside. Under the surface, sector and regional dispersion is widening. U.S. staples and value-oriented retail show resilience while big-ticket discretionary and home improvement slow. European earnings look strong but price action is soft, and China faces property stress and a weakening luxury consumer even as it gains share in AI. For equities, the balance of risks is shifting toward how long higher for longer yields, tight energy markets, and geopolitical flashpoints can coexist with strong margins before something forces a repricing. Into the next few weeks, the key signals to watch are long-term Treasury yields, Fed communication around cuts versus a pause, oil prices and inventory data, U.S. consumer spending patterns, and any escalation in China-related sanctions or property sector stress. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.